Welcome to Talk Tickers. Today, we're demystifying the option Greeks. If you've ever stared at an options price and wondered, why is this moving the way it is? Especially when it's not just about the stock price, well, you're in exactly the right place.
All right, so here's our game plan. We're going to start with the big pricing puzzle, introduce you to the Greeks, talk about price, time, and volatility, then get into some advanced stuff and even look at a live trade. Let's turn these scary-sounding terms into tools you can actually use.
Okay, first up, the options pricing puzzle. We're going to uncover the hidden forces at play here. This is the fundamental mystery that every single options trader has to deal with.
So why does an options price change? Have you ever seen a stock go up, but your call option barely moves, or maybe it even drops in value? It's maddening, right? Well, that's because there's a whole lot more going on behind the scenes. It's not just one thing. There are a bunch of different forces all pushing and pulling at the same time.
So what are these key factors? Well, of course, you've got the price of the stock itself. That's the obvious one. But then there's the time left until it expires, the overall market volatility. The fear and greed factor. And yep, even current interest rates. All of these have a massive impact, and you've got to understand them to get a grip on your risk.
Okay, so if we know what affects the price, how do we actually measure it? How do we put a number on the risk from time just ticking away, or a sudden panic in the market? Well, that's where our toolkit comes in. Let's introduce the Greeks.
So what are the Greeks really? Think of them like the dashboard in your car. They're a set of gauges that give you a theoretical way to judge your exposure to all those different factors we just talked about. They don't predict the future, but they tell you exactly what's happening with your trade right now.
All right, here they are, the 5 key Greeks you need to know. Delta, Gamma, Theta, Vega, and Rho. Now we're going to break each of these down, but we'll start with the ones that have the biggest, most immediate impact on your trades day in and day out.
Okay, let's dive into the big 3 drivers: price, time, and volatility. These are the main gauges you'll be looking at constantly. They have the most powerful, most immediate impact on your options price.
First up, we've got Delta. This is your speedometer. It's super simple. It tells you how much your options price is expected to move for every $1 change in the stock price. So if your option has a delta of, say, 0.50, it means for every dollar the stock goes up, your option should go up by about 50 cents. It's your number one measure of how much directional risk you're taking. Next up is Theta. Now, if delta is your speedometer, theta is kind of like a countdown clock, or maybe a leaky gas tank. It measures how much value your option loses every single day just because time is passing. They call it time decay for a reason. It's this constant nagging drain on your options price.
And check out this chart. It shows this perfectly. The decay isn't this nice, slow, straight line down. No way. You can see the time value. That dark blue bar just drips away slowly at first, but then as you get closer to expiration, it just falls off a cliff. That acceleration is a real killer, and it catches a ton of people off guard. And it's not just me saying it. Here's a great point from Fidelity. At the money, options experience nonlinear time decay, and its decay accelerates around the last 30 to 45 days of the contract's life. Seriously, that last month, time becomes your absolute worst enemy. That clock is ticking, and it's ticking fast. All right, let's talk about Vega. This one measures sensitivity to volatility. Now, implied volatility sounds complicated, but it's really just a measure of how much uncertainty or, let's be honest, fear is baked into the market. So, Vega tells you how much your options price will pop if things get crazy, or how much it'll drop if everything suddenly gets calm. It's like your portfolio's weather forecast.
All right, so we've covered the big 3. Now let's get into the more advanced stuff, the next level of the toolkit with Gamma and Rho.
So, let's talk gamma. If delta is your speed, then gamma is your acceleration. Simple as that. It tells you how fast your delta is going to change as the stock moves. If you have a high gamma, your position's risk can change on a dime. 1 minute you're cruising, the next you're flooring it. That's why it's so important in things like a gamma squeeze.
And then there's Rho, which measures sensitivity to interest rates. Now, for the longest time, nobody really cared about Rho, right? Because rates were basically zero. But now, with rates moving all over the place, Rho is suddenly back in the spotlight. It's become a really important factor, especially if you're trading options that are way out in the future.
Okay, theory is one thing, but let's see how the Greeks actually work in practice. This is where the rubber really meets the road, managing a live trade. So check this out. On the left, you see the trade when it started.
It has a positive delta of about 4.5. So it's pretty neutral, maybe slightly bullish. Now look at the picture on the right. This is the exact same position later on. After the market moved, the delta has completely flipped to negative 52.
So what happened here? You started with a positive delta of about 4.5, and now you're sitting on a negative delta of almost 52. The big question is this even the same trade you wanted to be in? Your risk profile has done a complete 180. It's gone from a little bit bullish to extremely bearish. This is exactly why you have to watch your Greeks.
So let's bring it all home. What's the big takeaway here? How do we use these Greeks to not just manage risk, but also understand what's happening in the market?
Remember, the Greeks are your dynamic risk gauges. They tell you about price moves with delta and gamma, they warn you about time decay with theta, they prepare you for market volatility with Vega, and they even clue you in on interest rate shifts with Rho. They aren't a crystal ball for predicting profits, they're all about understanding and managing your exposure.
And in today's markets, which can be pretty wild, Vega has become absolutely central. Why? Because big swings in sentiment can have a massive impact on option prices. Understanding Vega means you can potentially trade the fear in the market itself, even if the stock isn't moving a whole lot.
And think about interest rates. For years, Rho was the Greek that everyone ignored. Now it's a huge part of the economic story, so it's suddenly back in the conversation, especially for those longer-dated options. It just goes to show you how different market environments can make different Greeks way more important.
So at the end of the day, the Greeks are about managing risk, not guaranteeing a reward. The real question is, how will you use them to trade smarter? They aren't here to give you easy answers. They're here to make sure you're asking the right questions about your trades before the market decides to ask them for you.
This is not financial advice.